Welcome to this explainer. Today, we're unpacking an absolutely critical compliance tool under the newly enacted Income Tax Act 2025. We are zeroing in on Section 267 and Section 263(6). Look, whether you're a chartered accountant, a tax professional, a CA student, or running your own business, you know that mistakes happen. But understanding how to legally correct those tax filings without inviting a mountain of undue penalties is basically a survival skill. So let's jump right in.
Picture this real-world scenario. Tax season is finally in the rear-view mirror. Your returns are filed, you're breathing easy, and then you're reviewing your books and spot a glaring error. You or your accountant just found a chunk of missed income that accidentally got left off the return. So what happens next? A few years ago, this might have triggered instant panic about impending notices, but the law actually provides a very structured legal pathway to make things right.
Here is our roadmap for today's explainer. First, an introduction to updated returns. Second, the legal framework of Section 267. Third, the detailed rules and conditions. Fourth, a practical taxation example. Fifth, compliance and common issues. And finally, a summary of key takeaways.
All right, Part 1, Introduction to Updated Returns.
Under the new Income Tax Act 2025, an updated return is primarily governed by Section 263(6). Think of this as a legal provision that empowers taxpayers to voluntarily furnish an updated return of income. It's an opportunity for self-correction to report that missed or additional income. But, as you might guess, it's not a free pass. It comes with a major condition. You have to be willing to pay the associated additional tax, which is calculated over under Section 267. Also, a quick terminology check. Under the 2025 Act, we've moved away from the old previous year and assessment year jargon to one simplified term, tax year.
Moving right along to Part 2, the legal framework of Section 267.
Now, if you're a seasoned practitioner familiar with the old Income Tax Act of 1961, you definitely remember Section 139(8)(a). The substantive rules in the 2025 Act carry over that same fundamental policy, but the new law structurally splits the mechanics to make it much clearer. Section 263(6) now dictates the rules and timelines for actually filing the updated return, while Section 267 is dedicated entirely to the math, handling the calculation of the additional tax payable. It's the same DNA, just presented in a much more logical, reader-friendly way.
So how long do you have to fix a mistake? According to the official FAQs and the statute, you don't have forever. Taxpayers have exactly 48 months to file this updated return, but pay close attention to when that clock actually starts ticking. It starts from the end of the financial year succeeding the relevant tax year. It's a fairly generous yet strict 48-month window that gives you ample time to audit past records and voluntarily declare any omissions before the door slams shut.
Let's hit Part 3, Detailed Rules and Conditions.
You have to understand that this provision is a one-way street in favor of the Revenue Department. Here are the absolute limitations of Section 263(6). An updated return cannot result in a return of enhanced loss. It absolutely cannot decrease your total tax liability, and there is no way it can increase a tax refund. Why? Because this is strictly a compliance tool for paying owed dues. It's an avenue for the government to collect missed revenue without having to drag you into harsh litigation. It is not a backdoor for you to retrospectively reduce your tax burden or claim a bigger refund. 1. That is the magic number here. As per the legal text, only one updated return can be filed per tax year. You can't just keep updating an updated return every time you find a new receipt. You get one shot per tax year to come clean. So as a tax professional, you need to make absolutely sure your math is comprehensive and 100% correct the first time around.
Let's make this concrete with Part 4, a practical taxation example. Let's say a taxpayer originally filed their return declaring a total income of 10 lakh rupees. Fast forward a year, they do an internal audit, and oops, they discover 5 lakh rupees of missed income. They decide to use Section 263(6) and file an updated return. So, the new updated total income becomes 15 lakh rupees. The additional tax, calculated under Section 267, doesn't apply to the whole 15 lakhs from scratch. It applies specifically to the difference, that newly declared 5 lakhs, along with any applicable interest and late fees. You're basically paying the tax you originally owed, plus a statutory premium for being late, which protects you from regular penal proceedings.
Which brings us to Part 5, Compliance and Common Issues. According to the Income Tax Rules 2026, the compliance steps are very clearly defined. Step 1, identify and aggregate all your missed income.
Step 2, compute the additional tax and interest strictly under the rules of Section 267. Finally, Step 3, you have to file your return electronically. And highlight this in your notes. Rule 165 mandates the use of a specific form called Form ITR-UN for this process. You'll want to make sure your tax software is fully updated to the 2026 rules so you can select the correct form.
Now, what are the pitfalls? As a practitioner, you must know the common issues that will render your updated return completely invalid. First up, if a search or survey has already been initiated against the taxpayer, the law strictly blocks you from using this provision for that tax year and preceding years. The gig is up. Second, a classic, painful mistake is filing the return but forgetting to pay the Section 267 additional tax before you hit submit. The proof of payment literally must accompany the return. And third, as we just discussed, trying to revise an already filed updated return is a strict no-go.
Let's wrap things up with Part 6, a summary of key takeaways.
Here is your rapid-fire recap. 1. Sections 263.6 and 267 successfully replace Section 139AA of the old 1961 Act. 2. You have a maximum 48-month window starting from the end of the financial year succeeding the tax year to get this filed. 3. It's a one-way street. It cannot be used to increase refunds or enhance losses. 4. You are strictly limited to one updated return per tax year. And 5. For compliance, you must use Form ITR-UN as mandated by Rule 165 of the new 2026 rules.
At the end of the day, the updated return is a remarkably powerful tool for compliance, but it is a costly one if misused. As tax professionals, the real question we need to ask ourselves is this: are our internal audit processes robust enough to catch these errors before that 48-month window slams shut forever? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.